Welcome back, everyone, to another one-on-one with Jerry Hall. Today's conversation is with Mr. Greg Foss. Now, Greg has been in financial services his entire adult life. Greg is an expert at understanding and analyzing risk. A tremendous amount of our conversation is going to revolve around those themes, Bitcoin and risk. I hope you pick up some tidbits from this. I sure did. If you really enjoy the content and you're new to the channel, please hit the like and the subscribe button. But without any further ado, here's my conversation with Greg Foss. So Greg, thank you so much for taking the time to join me today. How are things going for you?
Well, they're going great. Thank you, Jerry. I have to admit, this is my second podcast of the day. I was just on with a guy from South Africa. Okay. So I was on with a South African podcast yesterday, my time. Yesterday, I think it was right around noon, if memory serves. And then today at 8:45 my time. So I'm based in Toronto, Canada. This is my second podcast of the day. So happy to be with you. Let me ask you how you're doing, because I don't even know where you're located.
I am in beautiful Costa Rica.
Come on. What part?
In a Perez Zeledon, which is like a county inside of the San Jose province. To give you some geography, I'm approximately 45 minutes east of Playa Dominical on the Pacific coast, which is kind of
Playa Dominical. I've surfed there. So
exactly, it's a surfing town. So if you go over the mountain on the main highway, you go into San Isidro de General.
Okay.
Which is where I'm located.
Oh, cool. Well, I've been to Costa Rica 3 times. It's the only Central American country I've been, but I've been there 3 times. So I've stayed at Jaco.
Of course.
Jaco twice, and then 1 time up in Tamarindo, which is up near Liberia, up in the. But always down there to surf and meet some great people. So one guy you should look out for. Well, there's 2 guys, 2 Canadians down there. Do you know John Vallis? Have you heard of John?
No, I have not.
John Vallis and the other one, Francis.
Of course I know who John Vallis is. Of course.
He's in Costa Rica right now.
Yeah, I saw a thing he did. I believe it was with you and Jeff Booth.
Correct. And he was there with no shirt on because he just has to be a knucklehead Canadian with no shirt on in a tropical nation. And then the other guy that's there is Francis Pouliot, another Canadian Bitcoiner who is famous, and he's in Costa Rica, and he may never come back to Canada. But look, beautiful country. One of the craziest things I've ever done is I took a 3-hour bus trip to go 60 miles to begin with. I went from Jaco down to Manuel Antonio. Okay.
Oh, sure.
And there's a beautiful national park down there. But my surf guide was from Florida. So we hop on this bus that's basically a bus for farmers. And my partner on the bus was a chicken. Okay. So I'm sitting right beside a chicken on this beautiful bus. It cost me $1 to travel for 3 hours, $1 United States to travel for 3 hours to get to one of the most beautiful surf spots I've ever been, down in near Manuel Antonio. And then you took a trip around this national park. Anyway, beautiful country. Thank you for having me, Costa Rica. It doesn't seem like you're a local. So where did you grow up?
North Bay, in like the San Francisco Bay Area in Northern California.
Okay. Nice.
Yeah.
Well, thanks for having me on your show, Jerry. That's an awful long.
You're so welcome. Well, I mean, it kind of segues into like why I wanted to have you here, right? So the reason why I'm in Costa Rica is I retired and let go of my construction business, sold everything I owned, went off to do some stuff in Hawaii on these organic farms. I was just learning and pursuing a passion, literally with, no expenditure. And that was wonderful. And when it came time to do something different, and I dove back into my finances, one of the elements of my finances was a home that I had purchased for my mother, which I expected, because I had bought it 20 years earlier, that I would use those funds to kind of fund the rest of my life.
Okay.
Right. I would figure out some way to either put them in bonds or CDs or something. That was the idea that I had in my mind in 2016. And when I went and spent the last 4 months of my mother's life with her before she passed, when she did pass, it was time to go through all this stuff. I went through all this stuff and realized my mother had reverse mortgaged the home. So
No.
there was no quote unquote nest egg for me. So I was, you know, 52 years old. I had $23,000 to my name, no assets, no nothing. And that started, and I started getting, I got worried. I went, wait a second. Either I'm going to have to trade my time for room and board on these organic farms for the rest of my life until I die, or I need to do something. And I decided to do something. And so I reached out to some friends that had done well in the markets over the years and started slowly becoming financially literate. And then it occurred to me that I wasn't alone, that a majority of the world is literally financially illiterate. And so when you look at cause and effect, I'm thinking to myself, well, financial literacy is really not taught in schools. It's not a topic. It's not important, despite the fact that every single one of us grows up in some economy where there is an exchange of value as just part of existence, whether, so that was odd to me. And I thought, okay, well, after a period of time, a friend encouraged me to start this channel. And this channel's been about a journey of me becoming financially literate, talking and finding and seeking out experts like yourself so that my financial IQ gets to a place where I can actually succeed in the game, right? This game is not going to change. I already know that. We're not going to have some global rebellion where we overthrow monetary policy around the globe, da 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 da. So I should learn how to play the game and succeed in the game. So hence why this channel was created, hence having you here. And one of the things you bring to the table, Greg, and I think is quite remarkable, is that you bring a way to analyze and look at risk that isn't often talked about, right? And it's definitely a complex topic, but the way you describe it allows a layperson to at least start to get an idea. So for those of you at home who may hear terms from Greg that you're unfamiliar with, write them down, go look them up in the meaning, and then come back to the video and watch it again. It'll make a lot of sense. So let's start with Greg. What got you interested in finance? And if you could compare and contrast your academic life prior to getting into the world of finance with, like, did you have financial literacy courses in school? Did you come out of school ready and knowledgeable about markets, about economies, or did you have to relearn or learn how to operate in that field?
So what a great question. And let me take one step back. What you're doing is absolutely fantastic. And as a side note, I'd love to introduce you to a orthopedic surgeon that I have met from Wisconsin that feels exactly the same way as you do. And he wants to write a series of papers to help the public. So I'm going to hook you two up, okay, after this show, because he's another thing. So America is a great country, okay? It just is. And so why do I say that? And I'm allowed to say that because I'm Canadian. I grew up in a town called Montreal, big city actually, and I was an engineer, and I went to a school in Montreal called McGill University, so hometown. But I wasn't really at McGill to go to study engineering. I actually went because I was in sports, and but I was good at math. I had gone through pure and applied sciences in my preschooling. And so I said, look, I understand engineering. I understand calculus. So I'm going to take engineering. But literally after my first week in engineering, I said, I know I don't want to be an engineer per se, but I'm okay at math and I can always switch from engineering to business, but you can never go from business back to engineering without having to relearn the 4 years of engineering that you would have skipped. Okay. There's just no way to do that. So I stayed in engineering. Again, I was there. Engineering wasn't my focus, but I'm like, okay, I'm there to do other stuff, but I'm learning engineering. going to school with some of the smartest kids in Canada, certainly in the United States too. There were plenty of not immigrants, but students from
foreign exchange students.
Yeah, exchange students. The Boston area has a feeder system into the McGill. So here's what I did. I realized that after 4 years, I didn't want to be an engineer, and I said, I'm going to apply to a business school in the US. I only have enough money to apply to one school. I applied to a school called Cornell University, which is in upstate New York. It's a great institution in the US. It's an Ivy League school. And I was lucky enough to get into it because if I was an American, I would not have been accepted with 0 years of work experience. But Cornell was trying to start a international business program, and hence they were trying to attract students from around the world. So my marks were good enough to get in, but my age was certainly didn't live up to US standards. So I go right out of McGill University right into an MBA program in the US and at one of the top schools. And I'm younger than everybody there. Okay. And that was somewhat imposing, but I never, one of the things that was beautiful is math to me was my first language, like it is for everyone. I'll throw this out. Math is the base layer of language. Everybody knows mathematics. Their second layer of communication is their native tongue. So whether you're Chinese or Spanish or English, doesn't matter. You all know math. Math is your base layer. That's the universal language. So, and that'll come back with our Bitcoin conversation at one point. But so anyway, I'm a young kid. I'm going to school at Cornell University. And that was my first initiation to finance. And I'm like, holy smokes, I understand math. I get it. But this finance stuff is so exciting compared to engineering. Now, engineering is much harder, okay? There's no question that the smartest people I've ever gone to school with are at McGill University in engineering. The people that make more money are the people I went to business school with at Cornell, not because they're smarter, just because they take, a lot of these guys were like Michael Saylor. Your audience probably knows who Michael Saylor is. He is a rocket scientist, but most rocket scientists are walking mainframe computers. Like they can't talk. They just are mathematical. And then when they try and talk, their second layer of language is not nearly as good as their base layer. Anyway, point is, the Cornell experience was amazing. I got exposed to these things called financial markets from a textbook though, okay? As textbooks would teach you how to analyze present value calculations, they taught you statistics and probabilities and et cetera. But they still were textbook interpretations of financial markets. I decided to return, as an aside, because I was young, and relative to the rest of the people in my class, I was lucky enough to live with some undergrads at McGill, and we had a common fraternity as our bond. Mine at McGill, theirs at Cornell. The point is, I lived with 6 undergrads as my Cornell experience. And these guys were great guys. They welcomed me like they're, but I'll tell you, then I got to know the true American culture, the difference between how Canada interprets something and how the United States interprets something. And I need to point this out, okay? I started the show by saying what a great nation the United States is, and it is a great nation, okay? It doesn't do everything right, but by and large, the world is very lucky to have the United States, okay? Because if we didn't, there'd be a lot worse things happening, okay? And I'll just throw this out as well. One of my roommates who was an undergrad while I was at business school, he was killed on 9/11, okay? So my heart goes out to all those people that have suffered those tragedies. That's why I can say things like, yes, I've lived and experience the United States for everything that's good about the United States, everything that has hurt the United States. So coming back to my experience, I learned finance from textbooks, 2 years in a top business school. And while I had the opportunity to work on Wall Street, I said, no, I want to come back to Canada and make a difference in my home nation. So my first job in Canada was working for the Royal Bank of Canada, Canada's largest financial institution. And I was working directly for the CFO. And one of my first projects, if not my first project, was examining our Latin American debt portfolio, because in 1988, Treasury Secretary Nicholas Brady of the US had decided that he needed to rescue, the first rescue that I've been involved with in the financial system, had to rescue the financial system because of their exposure to Latin American debt. Lo and behold, Royal Bank of Canada was insolvent when I started working for it. 1988, if you had taken the value of the loans to Latin American countries where they were trading in the secondary market and marked the portfolio of the bank down to that level, like any trader has to do on a day-to-day basis, banks don't have to mark their loans down. The write-off on that would have evaporated the book value of equity of the Royal Bank of Canada. I'm like, what? Hold on a second. You don't learn this in school. I am working at the largest financial institution in Canada, and it's insolvent. And so are all the other banks in New York and in Europe, because they had all the same problems. Well, let me tell you, Jerry, you don't learn that stuff in a textbook. So very quickly, I'm like, oh, Jesus, excuse my language. I go to the CFO. I go, Emil, like, we have a big problem here. And he goes, I know, don't tell anybody. I'm like, what? This is how finance actually works. You don't tell people that they shouldn't be depositing their money in your bank. And then I thought about it for a second. I said, well, firstly, most Canadians still believe that these banks are too big to fail. And that is the truth for most of the world's largest banks. They are too big to fail because if they do fail, the cascade effect and the intertwining of all the financial institutions and counterparty risk in the world would be a domino effect. So why are they too big to fail? I just explained to you. How do they have a backstop? Their central banks will essentially print money to keep them afloat. Okay. So you see it regularly in the financial markets in my 30 years. But remember what I just said, though. In 1988, I am introduced to something you never learn in a textbook. And then you realize that fiat currency is a Ponzi. I'm like, geez, this is what I learned in 1988, that the fiat currency is the Ponzi. Now, I didn't have the solution, and I wasn't about to go to my first job and my boss and say, I'm going to the newspapers, and a 25-year-old kid is going to go out and tell the world that the financial system is built, or held together by baling wire and masking tape. Okay, I'm not going to do that. But I'm like, wow, this is pretty scary. So I explained it. In my head, I just said, okay, it is what it is, but they certainly don't teach you that in a textbook. Okay. So I went from trading Latin American debt to becoming a high yield bond trader to try and start up Canada's high yield junk bond market, much like Michael Milken did in the United States, probably 10 years prior to me coming on in Canada. Milken was a genius. He developed a market that allowed people basically to say, hey, not a bad thing if you're risky, just pay me for it. Meaning if I want to borrow from you, it shouldn't be an on-off switch. When you go to your bank, they shouldn't say, Greg Foss, you qualify for a mortgage versus Greg Foss, you don't qualify for a mortgage. It should be Greg Foss, who's a really high quality credit risk, qualifies for a mortgage at this mortgage rate. And Greg Foss, who's not a good credit risk, has to pay a whole bunch more, but we will lend him the money because on a risk adjusted basis, it makes sense for us to lend him that money. So perhaps, Jerry, that's why I have always tried to simplify or look at things in markets from a risk perspective. I often say there is always a price. You cannot tell me that there's no price that you would buy something at, either a low price or a high price, or there's no price you would sell something at a high price. Okay. For example, and I'll take this to an extreme. If you could cure cancer, is there a price you would pay in terms of something that could be as extreme as, you know, having to do, you know, it's something you can't even think of, but the reward is curing cancer. Well, chances are you would say, yes, I would probably do that. The flip side is, take a family member who is dying of cancer, the same thing. Would you do just about anything you could? Well, that's called a price. It's not always paid in a dollar denominated basis. It could be paid in a commitment to do something. The point is, don't ever tell me there's no price, because let's talk about something you believe has no value. Don't tell me there's no price you would buy it at. How about that price is zero? I'll still buy it. My price just happens to be zero, because then my upside is unlimited and my downside is zero. Well, who sells stuff at zero? Not too many people. The point is, between zero and the price you want to earn or be rewarded for, that is called a risk spectrum. And that's when you need to figure out at what price you own something versus what price you sell something versus what price you consider buying it. And how do you consider buying it? It's only expected value analysis. It's statistics, it's mathematics, it's pretty simple stuff. So whether it's, we're talking financial markets or commitments you make in your life to fulfill some obligation, it's risk analysis. And that's how I lead my life. And I could get pretty crass about some things I would do for a price, but yes, I know what I would do. And there's various prices that I will consider doing it versus prices I won't.
Well, it leads me to like a direct question, right? Because, and I could be wrong, but my thesis for the investment in the digital asset space, basically my portfolio is anchored in Bitcoin. And then I have subsequent smaller bets on things that I think are extremely impactful technology, smart contract platforms, et cetera. And that really, there could be lots of debate about that, but that's the way I'm going about it. And that thesis, though, is built on this premise that the debt load that the world has created forces the world to have monetary policy where those closest to the spigot get to borrow money at an ever decreasing rate of return. In other words, they need to do this because they cannot roll their debt over if rates go up. So it's like monetary policy almost has it written in stone that unless there is some global debt jubilee, we can expect lower and lower and lower rates, which create just this virtuous cycle of more borrowing to pay off previous. And this has been a thing that we've seen grow out through your career, right? You came into the workforce probably about what, towards the end of Reagan's first term. He had another term, and then Bush. So you were there for like the great credit expansion that left industry and went into the retail markets and watched the world create this all-inclusive debt orgy, as Raoul Pal calls it. So my question to you is, from a risk analysis perspective, do you agree with that thesis that governments around the world have no choice other than to keep rates extremely low and just keep servicing the debt with cheaper and cheaper credit?
Yes, 100%. So I'm a credit guy. I'm a high yield guy. I always look at stuff from a credit perspective first. And you nailed it. It's only mathematics, Jerry. Now, so when I started trading credit, the base level of interest rates, i.e. the US Treasury 10-year, was double digits, okay? It was 12%. And over the 30 years that I've been involved, I'll just point out what you said. Yeah, interest rates have declined. They've declined because of two things. Inflation expectations have declined, whether they are expectations as measured by a faulty basket of benchmarks or not, i.e. the CPI. The point is, interest rates in my career, the base level of interest rates of the US Treasury 10-year have gone from 14%, down to under 1%. They based at 60 basis points or 0.6%. in the 10-year about over a year ago. Now, why did that happen? A combination of inflation expectations that were reduced because it was Volcker that came in the early 80s to stamp out inflation. Okay. So it did start a debt jubilee, and debt is a contract. And therefore, being a contract, it is based on mathematics. There is no subjectivity about it. You do not change that terms of the terms of a contract. They are written in stone, and the only way you can change those terms is in the event of a default. Okay, and then it's restructured, and you go to the courts and everything like that. So this is a fiat contract, and let's talk about a couple of the absolutely very intelligent points you made. Okay. Yes, we cannot stop because we have expanded this debt balloon so much that even servicing the interest on the debt causes that debt balloon to expand more and more, because our economy cannot possibly outgrow the pace that interest is growing at. So that's what's called a DEBT, debt spiral. Okay, not a death spiral yet, but a debt spiral.
DT, death spiral. Okay.
DEBT.
Oh,
debt.
The word debt.
Okay, but then it's not a death spiral, but it could be a death spiral. So how do you service that debt? You cannot do it with the revenues from your tax base without continuing to worry about other things that you're trying to fund, like your social services and everything like that, which means mathematically, Jerry, I think you said this without realizing you said this, you have to print money. To continue this debt expansion, we have now passed the point of no return where you have to print money. So interest rates are not going higher. That is almost certain as well, regardless of what inflation expectations or credit quality concerns dictate. And then secondly, money printing will never stop, because that is what is needed to solve this debt spiral. Otherwise, the debt spiral just continues to expand, and you can't pay the coupon unless you print the money to pay the coupon. Pure mathematics, it's not that difficult. Think of it as this. Your numerator is growing 4 times as fast as your denominator. Your denominator is your global GDP. Your numerator is global debt. It is 4 times the size of your denominator. And that contract in the numerator has a coupon on it that is growing as a function of the contract. Again, it's only math and it's only a contract.
Well, let me jump in here real quick, Greg, because I think this is a perfect intersection to ask you to, for the viewers and for me, to explain this one particular function. And it's the function that monetary policy used to have new inflated money pay old debt. Could you explain that mechanism, the value to let's say a government who has the ability to issue a bond, even if the market doesn't want it, it has a backstop of a central bank that will take the asset, i.e. issuing into existence this value, we'll call it currency, right? So there's this mechanism about inflation that makes inflation very advantageous for the government, not you, the citizen, right? Not you, the citizen, but the government, as far as some semi-logical way to pay off more debt with less money. Could you explain that mechanism real quick? I'm sure it would sound better coming from you than me. So it's as simple as this.
It's as simple as this, you guys. The government has, and the central bank has the luxury of printing money. Imagine if you had you're the guy that took out a mortgage and you said, I have all this credit quality because I'm working hard and I have this free cash flow and everything, but I also have a printing press in my basement that the bank is going to take my money. Dang, are you going to take your time and work hard, or are you just going to go in your basement and print the money to pay your mortgage? Flip it on its ear. That's what the government has as a backstop. And if it hadn't been abused, we would be in decent financial shape. But it continues to get abused by what's called socializing losses. So in my career, and I'm losing perspective as to what I've said on a previous podcast versus what I've said today with you. But did I mention, so 1988, I started with Royal Bank of Canada. I mentioned that for sure. LDC debt crisis. It was a form of socializing losses because what did Brady do? He actually changed a 5-year obligation, which was a loan, into a 30-year obligation, which was backstopped by US Treasury zero coupon notes that would for certain accrete to 100 cents on the dollar. So the 25 cents on the dollar that the banks had as value on these Latin American countries, it got backstopped by US Treasury securities so that those loans could be floated back on side to 100 cents on the dollar, and there didn't have to be any write down on the equity of the banks.
So the risk adjustment mechanism got basically sidestepped or end around.
It was an accounting gimmick. It was an accounting gimmick. It was a brilliant accounting gimmick. And it was my first introduction to, okay, so you learn accounting and then you realize how the government can come in and, bring various accounting rules that didn't break any laws. But if the common citizen, as Henry Ford said over 100 years ago, if the American citizen understood how banking really worked, there'd be a revolution in the morning, right? So that was my first introduction to that. Then long-term capital management in 1998, so 10 years later, you had a Nobel Prize, a team of 2 Nobel Prize winners there that were managing a hedge fund with 90 to 1 leverage. Okay. So if you think banks are over levered at 25 to 1, these guys were 90 to 1 levered.
Jim Rickards doesn't talk about that particular element of the structure.
Oh no, they were 90 to 1 levered, and they had 2 Nobel Prize winners that were selling volatility to the street. Selling volatility means the street was coming to them to purchase insurance, because that's what insurance is. It's insurance against vol. The street was purchasing vol or purchasing insurance from long-term capital. They were short vol, and vol exploded. And the Nobel Prize winner said, oh my God, it's trading at 2 standard deviations of confidence based on our data. And then you do a little bit of digging, and they had based their data on 6 years. 6 years. These are Nobel Prize winners who based their entire business on 6 years of data.
Which for you, or for those that are following us at home, it's like this much data.
It should be based on 100 years of data. The problem is volatility was never measured before. So they had this much, okay? And they put 90 to 1 odds on it, and they got bailed out by Wall Street, or by Wall Street. That's the second socializing losses that cost a lot of money. Okay. And who absorbs it? The central banks. Okay. Fast forward to the great financial crisis 10 years later. Are you getting a theme here? Every 10 years, there's something pretty awful happens in the financial markets. And why is that? Because financial markets are over levered. That is the ingredient in capitalism. Okay. 2008, 2009, I was working at a hedge fund, and honest to God, I'm going to tell you, Jerry, yes, the world was ending. Okay. And the Fed had to step in. But why did the Fed have to step in? Again, it was because of leverage that was pumped into the system using collateralized debt obligations and all these structured products that were based on subprime mortgage exposure. Okay. The world was unraveling. The Fed did the right thing by establishing programs like the TARP, the Troubled Asset Relief Program, and whatnot. But again, it was socializing losses, and it was transferring risk from the financial system onto the balance sheets of the central banks. If we had done the right thing in 2011 and 2012 and actually paid the piper for what we had accumulated for the last 25 years of financial shenanigans, we could have survived. Meaning we could have actually paid down the debt so that it didn't become a debt spiral, but we didn't, because every time the Fed tried to taper, the equity markets went into a tantrum. And they look at equity markets as a voting machine as to whether they're going to get another 4 years in office. Okay, very simply. So they didn't. They said, we're not going to taper. And by not tapering and by continuing to allow the debt balloon to expand organically because of the contract, which requires that debt to pay a coupon, that balloon expanded to a point where we are now. And it is impossible, as you rightly point out, that we have to continue to print the money. So a long drawn out answer as to what this happened over history. Every single financial crisis is the cause of liquidity being drawn from the system and the Fed having to say, that's it, we're opening all the spigots and we're going to just flood the system with liquidity, as we're seeing today. There will be another financial crisis. Well, okay, so then 2008, 2009, I honestly thought the world was ending. I was working at a hedge fund and we were making a ton of money because we had the right trades on. And I was still so concerned that the world was unraveling and money would mean nothing. Okay. Because, you know, first of all, you couldn't collect it because the people that owed you the money would not be able to pay it to you because these were the insurance contracts you'd purchased from other people. At the end of the day, we hit COVID without paying down the socializing the losses that we'd accumulated in the past. We hit COVID, the world unraveled more quickly. Notice that in 2008, 2009, it took about 3 years for the world to unravel. In COVID, it took less than 3 months. Right. And the next financial crisis will be even quicker than that. And it'll be more severe. And it might not be one where the Fed can print their way out of the jam because people will just say, that's it. I've seen enough of this garbage. It's over. You need to hedge that mathematical possibility. And in my opinion, a higher than accepted out there in the marketplace, a higher than normal or common man's language, a higher than appreciated probability that this will happen, again, based on mathematics.
Well, I agree. And I think that really sets the stage for most of my audience that would be tuning in, have already, at least to some degree, bought the Bitcoin in this digital asset space is a way to create monetary policy and monetary networks that are governed by code, not the whimsy of any political party at any political time for any economic environment. This, to me, is a sound stage to build upon, right? Good behavior will be rewarded, and bad behavior tends to get flushed out of the system pretty quickly, or those who
100%.
Participate. So let's dive into, so having been a veteran in the markets and having the skin flayed off your back many times due to forces outside of your own control, right? You can only analyze and allocate. You don't set policy. So you have been victim to this on a big stage, probably we'll say the world's largest stage, because I don't think there has ever been in the recorded history a market like the United States financial capital markets that can be equated to anything else in history. So we'll say it's the largest stage on the planet, in the history of the planet. You've been there, you got the scars to prove it. Now let's introduce Bitcoin into the Foss man's sphere of, where did it come into your view? How did this digital asset space get presented to you? And did you see something in it that, from your own antecedents, right, your own history, go, I need to be a part of this because A, B, C, and D?
Great question.
I'd love to hear that story.
Yeah, well, thank you for asking. So then I was working at a hedge fund, as I mentioned, in the great financial crisis. We navigated that financial crisis well. That is to say, we made a lot of money for our clients and we didn't go out of business like a lot of other hedge funds did. And our hedge fund ended up getting bought by a larger institution that turned out in hindsight to be a bad partnership. So I had signed a 2-year deal that I would stay with the purchaser of the fund for 2 years. But much like you do in life, you say, okay, maybe you've had enough of being a risk manager sitting in a chair where you can't breathe sometimes, when sometimes you have a trade on that is strangling you and you feel that pit in the pit of your stomach, that first of all, how could you have been so stupid to put this trade on, and you're costing your clients money? And in order of priority, it's easiest to lose your own money. It's second easiest to lose a bank's money. And it's absolutely horrendous to lose money of friends and family and people that have entrusted you with their savings. Okay. So if you're a good risk manager and you have a heart, you feel horrible when you lose money. Peter Schiff has no heart. Okay. He absolutely is out there pitching the fact that Bitcoin is garbage and gold is the savior. And he's cost so many people so much money. The man possibly has either no heart or no ethics or both. But the point is, good risk managers have heart, they have ethics, and they manage risk. So I've put my hand up and I said, Jerry, I've had enough of this. I'm going to go and be a school teacher. Okay. And I went and I honestly had good intentions, but I never became a school teacher. Why? One of my an acquaintance from Montreal, even though I was living in Toronto, I'd moved to him. He called me up and he goes, I need to show you this thing. It's called Bitcoin. And I did like everyone in the financial markets. I had heard about it. I was no longer managing other people's money, but I still had some money of my own. And he was asking me for an investment in his firm to be able to bring a Bitcoin ETF to Canada, a closed-end fund that would be able to offer Bitcoin as an investment vehicle to all the to the clients of Canada that would trade on the Toronto Stock Exchange. So I said, well, I better figure out what this thing Bitcoin is first. It's a Ponzi. Everything I've read in the press, it's a Ponzi. So it is a Ponzi. But, I'm open-minded and I say, well, maybe it isn't. So Fred, that was his name. Fred, we sat down in one of my pubs in Montreal. I'm not sure if I told you that I'm an owner of a bunch of pubs still in Montreal. But
you are. I knew that.
The cool thing is we sat down and he talks about Bitcoin. And I'm like, okay, but the one thing he showed me that sold me at that very moment, he showed me the blockchain in action. Okay. He showed me on tradeblock.com the transactions that were taking place around the world and the block that had been mined 10 minutes earlier, or, how many minutes earlier, who the miner was, what the block height was, how many transactions went in. And I'm like, as an engineer, don't forget, as an engineer.
Exactly.
This is visual for me. This is beautiful. And okay, now talk to me. This only has 21 million. It's fixed supply. There's no centralization. No one controls this. And it works and you see it. I'm in. I'm funding your company and I'm buying Bitcoin. Because it's what I've been searching for 30 years up until that point. Well, 2016 from 1988, I guess it was 28 years at that point, okay? I had been looking again for the solution to the fiat Ponzi. And I assumed Bitcoin was a Ponzi. And then I did some work and I'm like, no. Bitcoin is not the Ponzi. Bitcoin is the solution. For me, again, though, what sold me that very moment, Jerry, the aha moment, seeing the blockchain in action. Okay. So then I said, dang, this is the most technologically beautiful thing I've ever. How does this work again? You get it on your wallet. You can transfer money anywhere or transfer value anywhere in the world. It settles in 10 minutes. Get the heck out of here. No. So I did. And I sent money to New Zealand, for God's sakes. And I'm like, what? This is settling in 10 minutes. This is effing beautiful. I love this technology. If you had tried to do that in the banking system, you have to do backflips. You have to cut off a finger, give it to the bank as collateral. There's chances it doesn't settle through the SWIFT system. It's the most garbage system ever in the world versus this beautiful thing of technology that is not controlled by anybody. I'm in. I'm helping to fund your company, and I'm in. And I'm buying Bitcoin. And at the time it was at $800 US. Okay. I need to couch this with two things. First of all, we were successful. We did bring the closed-end Bitcoin fund to the Toronto Stock Exchange.
What is that ticker symbol so people could go look?
So that ticker symbol was QBTC. Okay. QBTC for 3IQ is the name of the company. So Q and then Bitcoin. And that morphed into exchange traded funds, beautiful exchange traded funds that we have for Bitcoin and other digital assets, Ethereum. Let's not talk about that at this point, but Canadians can get exposure to those asset classes in their tax advantaged investment accounts. We did it. We took the Ontario Securities Commission to court. And now Canada has a well-developed digital asset platform that other investors can get exposure to this beautiful technology and store of value. Okay. I need to couch this though. First of all, my risk-adjusted trade, I should just put all my money in Bitcoin rather than funding this other startup, because it was all a lot of hopium, and we almost ran out of money and we almost didn't succeed, but we did. And the shareholders my shareholder money and the shareholders I brought to the table have done quite well. We didn't do as well as if you would put all your money in Bitcoin, but the flip side is, if you're a good citizen, we have a product in Canada that's helping create a vehicle for other Canadians. The more important thing, Jerry, is that I have to point out is this. Yes, I did get involved at $800 a Bitcoin, but Bitcoin today, 5 years later, is better value on a risk-adjusted basis today at the price that it's trading at than it was when I got into it at $800.
Well, at 800, there was a much higher percentage chance of zero than there is today.
God bless you, man.
No,
that's exactly how you have to look at every single investment in your life. Okay. And all these people are running around saying, oh, I missed it. I missed it. You haven't missed anything, because the asymmetry of the trade still exists today. And I can run through a scenario with you where I think Bitcoin goes to over $2 million a Bitcoin.
That might be fun for the viewers. And we'll close on that one, but I have this for you. The world, people in the world really make decisions based off of comparing and contrasting something new to something they know. And when you have no when you don't know how money works or how the last 100 years of a monetary policy has affected this or that and the other thing, I try to make things simple. I try to get things simple so that, even if they're extremely complex. One of the things, and we started the conversation with this, is if you on one side know that monetary policy around the world is continued deficit spending, continued incremental tax increase on its tax base, and a proliferation or increase in your currency supply, diluting all the other old currency, then the Bitcoin story makes sense if you understand fixed supply, if you understand network effects, and if you understand code that is not going to be altered or changed or manipulated based off of any one particular segment's needs, wants, or desires, right?
Correct.
I've heard you talk about this before, and so I just wanted to get your point on, or your input on, where would you, if somebody came to you and said, Greg, I'd love to know what you know, but I know that would take me 30 years because it took you 30 years to get where you are. Where should I go to start my education to understand the world outside of crypto, so that when I compare crypto, I have a firm, solid basis to go off of? Where would you direct a new person who wants to have, at some point, your level of understanding of how the machine works?
Okay. You know what? I actually wrote a paper so that I could just give people that paper and say, this is my experience over 30 years. And I explain how markets work, priority of claim of debt over equity. Don't look to equity markets unless you understand the debt markets first. I mean, these are all first principles that I've lived by and I've managed risk by. I don't have a whole lot of go-to books besides the book by Jeff Booth The Price of Tomorrow. It's such a great book. Okay. In fact, it's the best book that I've ever read. The reality is, why is it so good, is because he's actually done stuff in his life, not like a lot of other academics that write books that they've actually never managed risk in their life. I mentioned to you at the outset of this program, before we were recording, that markets and models to value in markets, you throw those all out the window when you hit a calamity like a leverage unwind. Okay. If you're managing other people's money and they get nervous, they don't care how well you've done. And in fact, if you've done better than the other people out there, they can even come to you and say, I'm selling you first, Foss, because you've actually done well. And I want to lock those gains in versus all these other knuckleheads that have lost me money. Excuse me. So you can actually be getting redeemed at a time when your performance is better than anyone else on the street, but it's human nature to sell the winner before they sell the loser. Doesn't matter. In an unwind, everybody is trying to take their cash back. And this is when the contagion hits the markets, and you take all your models that you've put in and you put like this and you throw them over your shoulder, and you're like, your margin clerk is tapping you on the shoulder and they're saying, hey, Foss, you got to deliver 50 million bucks in T+2. I don't care how you do it, but you got to get me 50 million. And you're like, God damn it. And then you're sometimes even in your own portfolio, you're like, you're not selling what you want to, you're selling what you can. And you're not selling the pure slice of your portfolio because some of them are more illiquid than others. And the markets are unraveling, and you take your model and you just put it and you throw it away. And I can walk you through a pretty funny story, but we don't have that much time. My chief risk officer at a hedge fund I was working with, it was a Harvard MBA. And I'm putting this trade on. He's like, Foster, what are you doing today? And I'm putting this trade on. And he says, you can't possibly be doing that. And I'm like, why? He says, because it's 100% risk-free. And I said, that's right, Jason. That's why I'm putting it on. And I was essentially hedging debt with put options where the maturity of the debt was shorter maturity than the options I was buying on the equity, the subordinated claim, and the capital structure. Suffice to say, he's a pretty smart chief risk officer, but he's an academic.
Hang on a second. I got to ask you a question. So with that method, basically what you're doing is using time to not.
Let's go through the trade. Here's the neat thing, Jerry.
Yeah, okay.
The bonds were a 6-month obligation. They matured in 6 months. It was on a company called Nova Chemicals. It's a big Canadian producer of not plastics, but like plastic bags and polychemicals. Okay. Nova Chemicals had 6-month debt that was trading in the low 60s, and it had a stock that was trading at $2, and you could purchase a put option on that stock for 40 cents at a $2 strike price. Okay, I was essentially being able to buy, and it was longer maturity than the debt. I was able to buy the put option at a price that was cheaper than the yield on the debt. And unless the debt matured at 100 cents on the dollar, you know that the equity is worth zero. And I'm putting this trade on, and my chief risk officer looks at me and he goes, you can't be, the markets can't be that inefficient. And I go, well, Jason, they are. And I showed him my blotter, and I showed him the options, and the thin edge of the wedge was, meaning the part that was most difficult to produce in volume was the put option. Okay. Was purchasing the put option. So anyway, I'm doing this
relative to the size of the debt.
To the size of the debt. I could have bought all the debt I wanted. Okay. It's just that the options market was the illiquid part. So I'm putting this trade on, and he's like, no, you're not. And I said, no, Jason, here, look, I'm showing you. And I showed him, and he's running out to a meeting, and he's scratching his head. He's like, how the hell is Foss finding these trades? And I go, Jason, how much can I do? And to his absolute, I'm bowing to him. He goes, infinity.
As much as the market will handle.
Do infinity, because it was 100% risk-free, okay? And that's the right answer. Again, what is the price or what is the size? Do infinity. And he walked out the door. So then I really start getting aggressive on this thing, and the equity markets are going bananas because the guys I'm buying the put options from need to what's called delta hedge their equity, which means they need to short sell the equity into the bid in the market. And all of a sudden the market, and I'm just sort of chuckling to myself. And I said, I didn't do this. It was my chief risk officer that told me to do infinity. And that's what happens in markets when models break. Okay. Or I should say, that's what happens with models when markets break. You find this stuff, and it's the most beautiful thing. So I will conclude by saying this. Bitcoin is the best asymmetric trade opportunity I've ever seen in my life that you can do in size. This other one was a great trade. I was doing it for my unit holders, but I couldn't do it in huge size. I probably did $6 million worth of debt face value versus, you know, a delta hedged amount of put options. But once the market gets, the debt price started to go up, the option or the stock price started to go down. So therefore your put protection evaporated. But Bitcoin, you don't need to worry about that. You have no counterparty risk. It's all math and code, as you mentioned, and that's the beautiful thing. It's decentralized. The best trade opportunity I've ever seen in my life. Okay. And we can run through that quickly, that statistical analysis. Just don't overthink this. Bitcoin at 20,000, 30,000, or 40,000 is a rounding error in price compared to where I think it's going to go. So if you own 0 Bitcoin, you are actually taking more risk than people that have a proper portfolio allocation to this asymmetric opportunity.
Well said. Well said. I want to ask a favor of you.
Yes, sir.
Would it be possible for me to get that paper? That
I've given it to the whole internet. I've given it to
link down here in the description.
Every single podcast I'm on. It's actually just gotten translated into Spanish. So I've met these kids from Guatemala that I met at the Bitcoin conference in Miami 2 months ago, who I love. They're doing real stuff, boots on the ground. And by the way, this is important, everyone. The real life applications of Bitcoin are far more substantial and far more important than some stupid white guy sitting up in Canada that's made a bunch of money trading in his career and thinks he's going to make money on Bitcoin. No. The important thing is it's going to change people's lives that are disadvantaged in all parts of the world that have up until now been cannon fodder for, rich white societies like, and I have no problem with skin color or whatever. The reality is, though, that the G7 nations take advantage of the bottom of the barrel and continue to shove the crap further downhill. Okay. It's over. The G7 is mathematically certain to debase their currency. And one by one, these fiat currencies are going to fail. It's going to start with the less than G20 nations, and it happens all the time, but that's why you need Bitcoin. You need Bitcoin as default insurance against fiat failure. No matter what country you live in the world, that's what you are purchasing. So yes, you can have a copy of my paper. It's out there. It just was translated into Spanish. And it's my way of telling people, look, I couldn't possibly download 30 years of experience in one podcast. You need to read my history. And I'm not saying my history is anything special, except that I've actually done it. And if you are listening to Steve Hanke, some endowed, stupid fucking chair in Johns Hopkins, and you can edit out that fucking part, but you're not allowed to edit out the how stupid he is and how conflicted he is. Okay. He is the exact problem that I'm trying to solve. I came from a boomer class like you, Jerry. I think we're about the same age. That is the most selfish group of call them not citizens, but age group that's ever been inflicted upon this world. Okay. We're scared to take a loss. We're scared to realize a loss. We need to be coddled by a bunch of pansy ass politicians. Bitcoin solves all that stuff, and it solves it to the benefit of the people that have heretofore been the victims of flawed monetary policy. Okay. You need Bitcoin. Everyone needs Bitcoin, but the people that are going to benefit most from it are the people who up until now have been the ones that have also been the victims of fiat currency and the Cantillon effect and whatnot.
I couldn't agree more. I kind of look at it like this, and this is a very simplistic kind of analogy, but the first 10 plus years of Bitcoin was really about establishing an asset that was really different than anything we've ever seen before. Just the sheer code-based, limited supply, fixed supply asset. I think the next 10 to 20 years is going to be really about the Bitcoin network and the decentralization and the global reach and the governance through code versus humans. This to me opens up so many things. I mean, we're both fans of what Jack Mallers doing with Strike, but he is not the only one working on the Lightning Network and advancing.
So these guys in Guatemala, can I call out my guys from Guatemala that translated my paper into Spanish? I was on stage in Miami, and I talked to the people that were listening to me speak in Miami, and I talked to them about these guys I had met 2 days earlier in Miami from Guatemala that were trying to do Bitcoin Lake based on the model of Bitcoin Beach in El Salvador. Now, I brought them out on the stage, I brought out the subject of a real use case that's happening in Guatemala. Little did I know that 6 hours later, Jack Mallers would be on the same stage announcing that he had onboarded a country. Onboarded a country, okay? And here's the funny thing, though. That country says in 60 days, we are going to mandate that all merchants need to accept Bitcoin. Hey, that's a big-ass ask, okay? The guys in Guatemala have the expertise, and they only live 3-hour drive from El Salvador. So they're now the guys that are going and implementing this for merchants in El Salvador. These guys are beautiful. They're called Ibex Mercado, based in Guatemala. They're doing boots on the ground work for El Salvador merchants to onboard or to accept Bitcoin as real life payments. Okay, guys, this is so exciting from an engineering perspective. So exciting from a store of value perspective. And quite honestly, the solution to so much crap I've seen for 30 years that take place regularly in what's called the developed capital markets. But the reality is they're not developed. They are massaged, okay? These capital markets are massaged by global central bankers who are conflicted, who are fat, lazy, intellectual curmudgeons. And this is why we have Bitcoin. And I've lived it for 30 years. And Steve Hanke, he's never managed risk in his life, okay? Don't listen to the academically, intellectually conflicted, lazy professors who write the textbooks that you're supposed to learn from. Learn from Jerry Hall, a man who realized he had to take his own destiny into his own hands. Okay. So I got to run. I'm sort of dressed like I'm golfing, and believe it or not, I am. And I need to run out to the golf course. All right.
Good luck, Greg. Thank you so much for your time. We'll catch you up. I'll stay in contact. And from Canada and Costa Rica, we wish you all a wonderful day. Thanks for tuning in, and we'll catch you next time.
I want to go with one final thing, Jerry.
Okay.
We are going to develop a North American plus South American plus Central American solution to this. And we're going to make all countries better for it. Okay. Right now we have a bunch of different communities, but ultimately we're all one community. But when we package this ecosystem as a solution that has no borders and no centralized control, God darn it, let's do it. Okay.
Heaven help those that try to get in our way. Pura vida, mi amigo.